How do you claim no tax on tips? Claiming the no tax on tips benefit requires you to follow a specific reporting process to qualify for the federal income tax deduction. To begin, you must be employed in a qualified occupation where tipping is a customary and regular part of the job, such as bartending, hairstyling, or food delivery. You are required to report 100% of your tips to your employer throughout the year, just as you did under previous tax laws. These tips must be voluntary payments from customers, as mandatory service charges or auto gratuities do not qualify for this specific deduction. Keeping a daily log of your cash and digital tips is essential to ensure your reported income matches your employer's records and the eventual totals on your tax forms. The primary mechanism for claiming this benefit on your tax return is the newly introduced Schedule 1A, which is used to calculate adjustments to your income. When you receive your W-2 for the 2025 or 2026 tax year, you should look for your tip income to be specifically identified, often in Box 7 or marked with a specific code in Box 12. You will transfer these qualified tip amounts onto Schedule 1A to determine your total eligible deduction, which is capped at $25,000 per year. This deduction acts as an above-the-line adjustment, meaning it reduces your adjusted gross income regardless of whether you choose to take the standard deduction or itemize your expenses. Once calculated on Schedule 1A, the final deduction amount is moved to your Form 1040 to lower your overall taxable income. Eligibility for the full deduction depends heavily on your filing status and your total income for the year. For the 2025 and 2026 tax years, the deduction begins to phase out if your modified adjusted gross income exceeds $150,000 for single filers or $300,000 for those who are married filing jointly. It is important to note that if you are married, the IRS generally requires you to file a joint return to be eligible for the tip deduction. Additionally, the taxpayer must possess a valid Social Security number to qualify, as individuals using an ITIN are currently excluded from this specific provision. Monitoring your total income is vital, as the benefit shrinks by $100 for every $1,000 earned above the phase-out thresholds. While the No Tax on Tips label suggests a complete exemption, it is crucial to understand that this legislation only applies to federal income tax. You and your employer are still required to pay Federal Insurance Contribution Act taxes, which include Social Security and Medicare taxes on the full amount of tips earned. Furthermore, this federal deduction does not automatically apply to state or local income taxes unless your specific state chooses to align its tax code with the new One Big Beautiful Bill Act standards. You should also ensure that any tips not reported to your employer are accounted for using Form 4137, though failing to report tips during the year can make it much harder to claim the deduction during filing season. Proper documentation remains the best defense against potential IRS inquiries regarding your tip deduction. You should retain your monthly tip reports, often submitted via Form 4070, and compare them against the totals listed in Box 12, Code TP, or Box 14 of your W-2. If you are self-employed or a gig economy worker, your 1099s may not always break out tips from base pay, so your personal daily logs become the primary evidence for your Schedule 1A. Because the One Big Beautiful Bill Act is currently set as a temporary measure effective through the 2028 tax year, staying informed about potential extensions or changes in IRS reporting codes is necessary for long-term planning. By maintaining precise records and utilizing the correct supplemental schedules, you can successfully maximize this significant tax break. For more informative videos on taxes, finances, and investments, we welcome you to subscribe to our channel. Thank you.